back to Hugh Hendry. Hugh is our guest host this morning, CIO at Eclectica. So Hugh, what does that mean for your commodity fund, your soft commodity fund, if that's the environment that we're going into? Eric writes in from Brussels and says, can you ask Hugh what his forecast is for the soft commodities for the near future in regards of some pulling back we've seen from the sector in terms of prices recently?
It's all the one trade, soft commodities, gold, oil, stock market, short the dollar, short treasuries. It's all the one trade.
Is it? Because at least in commodities you can see a contraction of supply to the market very quickly. I mean, nobody's going to take their equity off the market as fast. So that won't change.
No,
but you can, I mean, there is this argument being made that the farmers are going to stop planting, they're going to stop buying the fertilizers because of the cost, and we're going to see other mines mothballing because there's just no point in putting supply into the market while prices are falling.
But what we came to understand, again at this time last year, we came to understand the magnitude of financial speculation which could come into these markets, which are small markets. Corn markets, a small market. And through the advent of the ETFs and pension fund asset allocation switches, you could be many times greater. The financial tail could be many times greater than the dog itself. And we had congressional hearings, if you remember, this time last year. So my misgivings, I see soft commodities as a risk asset today. Risk assets are rising. We have an agricultural equity mutual fund, and it's rising. But it fell 40% last year. So how much, again, do I want to allocate of my wealth into something which has 40% downside, might double? My answer is I've got about 12% of my hedge fund invested in that asset. And again, unlike the rest of the world, I don't really have an appetite for risk this year. I have an appetite for risk, I'm thinking maybe next year when people are more fearful again. But
so you're saying no risk this year, stay in bonds, stay in stuff you know.
It's quite hard, because look at the way
you miss the potential of a 40% upside or whatever it is that we've seen here over the past couple of months.
The European futures have rallied now about 55% from their lows. The stock market in 1929 rallied 52% from its lows, from November to June of 1930. And it's hard. Jeff said, how do you feel today? You girls are up there kind of, waving your bras at the screen saying, sorry, I didn't mean that. But, you say, hey, euphoric, the market's going up, it's jolly, jolly, jolly. And it's hard to resist the temptation. Yeah, that's why I say bras. I was saying temptation. Sorry. It's hard to resist that. Yeah, it's very hard to resist that, and to say, but the probity of investing, the desire not to lose money, requires that you kind of and be the other side, of everyone, underwrite the other risk. And as I say, there's something about risk aversion. It just doesn't work at this time of year. It does work, just not at this time of year. And so, as I say, I come in here and I talk to everyone.
Okay, if you'd like to write in, Hugh Hendry is with us for the next 30 minutes or so. Squawk Box Europe at cnbc.com.